Welcome. We're diving into a number that has grown too big to ignore: the U.S. national debt. It's time to understand why this colossal figure now truly matters. If you check the giant debt clock in Times Square, you'll see an impossible number. It has crossed $35 trillion and is moving fast toward $38 trillion, rising every second. To grasp $38 trillion, imagine stacking $1 bills. That pile wouldn't just reach the moon, it would go far beyond it. The sheer scale is hard to comprehend. For many years, policymakers told people not to worry. They said deficits were normal and manageable, claiming the country owed the money to itself. The debt was often treated like a scoreboard in a video game, big and scary, but supposedly without any real consequences for everyday life. But things have changed. The math has shifted, and the pressure is real. For the first time, the government is spending more on interest payments than on national defense. This is a huge shift. More money is going toward past borrowing than protecting the country in the present. Interest payments alone are approaching $1 trillion every year. As the debt grows, the cost of maintaining that debt also grows. The government must keep paying interest, and that payment keeps increasing, creating a serious problem. Unlike a normal household, the government cannot simply cut back easily. Mandatory programs like Social Security and Medicare are promises that cannot be broken without major consequences. Because of these fixed expenses, the government doesn't reduce spending, it borrows more money. It takes on new debt just to pay the interest on old debt. This is like using one credit card to pay off another. This creates a loop that feeds itself. More debt leads to more interest, which leads to more borrowing. The cycle reinforces itself, making the total debt even bigger. This debt spiral doesn't grow slowly. It grows faster over time, making it increasingly harder and harder to control the system. At this point, the system is in a difficult position. There are only a few ways to deal with such a large amount of debt, but each option comes with serious problems. None of the solutions are easy, and most of them are politically very difficult to implement. The challenge ahead requires serious choices. National debt is a huge challenge for many governments. Today, we'll explore the three main ways governments deal with overwhelming national debt. These solutions are austerity, default, and what is often referred to as a soft default, which uses inflation to manage the debt burden. The first option is austerity, a traditional approach that aims to balance the budget and reduce debt by aggressively raising taxes and cutting government spending. This involves raising taxes significantly and reducing large-scale government expenditure, often including social programs. However, austerity measures are extremely unpopular. Leaders who attempt to cut benefits or raise taxes too much risk losing public support immediately, making such policies politically difficult, if not impossible, to pass. A rapid reduction in spending can also shock the economy, which has become dependent on government support, potentially slowing growth or even causing a recession. The second option is default, meaning the government simply refuses to pay its debt obligations. While some countries have defaulted in the past, for a major economy like the United States, this would involve refusing to pay back holders of U.S. Treasury bonds. A U.S. default would be a catastrophic shock to the entire global financial system, as Treasury bonds are considered a cornerstone of safe global investments. The resulting panic, disruption to trade, and financial crisis mean that default is generally not viewed as a realistic option for major economies. This brings us to the third option, often called a soft default, which manages debt through inflation. A soft default means the government pays back its debt, but with money that has lost value over time due to inflation. When inflation rates are higher than interest rates, the real value of the debt silently shrinks, reducing the government's financial burden over many years. Crucially, this method avoids the political backlash of austerity, as it doesn't require immediate tax hikes or cuts to popular government programs. However, this approach has a hidden cost. It reduces the purchasing power of people's savings, especially those held in cash or low-interest accounts, punishing savers quietly. This scenario often leads to fiscal dominance, where the government's debt levels influence the central bank's monetary policy, keeping interest rates lower than necessary to prevent debt servicing costs from skyrocketing. These are the three paths governments face when managing massive national debt, each with its own significant economic and political consequences. In-depth look at how inflation acts as a quiet strategy for managing national debt. This economic process is continuous, running in the background, subtly shaping our financial world. As this process continues, the effects become more visible over time, often in unexpected ways. Even moderate inflation has a strong impact. For example, at just 5% inflation, the value of money can be cut in half in about 14 years. This long-term decline creates a major shift in how people experience the economy every single day. This means savings slowly lose their real power, even if the amount of money in your bank account stays numerically the same. Prices rise across the board for everyday items, hitting necessities hard like food, housing, and essential services. A critical problem is that wages often do not keep up at the same speed as these rising costs. This creates a paradox where some parts of the economy appear to be booming while others suffer. At the same time, asset prices like stocks and real estate may sharply increase in value. This can create the feeling that your wealth is growing, but in reality, it is often just the value of money itself that is falling. The system thus creates a significant difference between those who own assets and those who rely only on income. History shows that this approach to debt management is not a new invention. After major events like wars, governments have used inflation to reduce the real value of large national debts. But today, this is happening in a much more complex and interconnected global system. In the end, the system is not designed to eliminate debt quickly. It is designed to manage it over time. Inflation becomes a tool. The process is intentionally slow. It does not look like a crisis at first, but rather a gradual, sustained change. Over time, the nominal debt number keeps rising, but inflation quietly reduces its real value, making it less burdensome. The strategy is not about stopping the rise of debt, but about controlling its impact and allowing the system to continue functioning over the long term. While this process may seem calm on the surface, its effects are profound and lasting. It fundamentally changes how money works, how savings behave, and how the entire economy evolves over time. Understanding this strategy helps explain why the debt keeps growing and why drastic changes are often avoided.